welcome to another edition of Nucleus Investment Insights. This week we have titled it Income Investors Beware. Let me get that up. And what we really wanted to sort of focus in on today, just keeping in mind that everything you're going to hear is general in nature and doesn't constitute personal financial advice. But really, what I wanted to try and focus in on is this idea that income investors have got their moment in the sunshine at the moment, but they've just been through a pretty dire few years if you were looking for your savings to generate income. And really now is a time you should be thinking about, if you are looking to live off income, you really should be looking at how you should be setting yourself up while interest rates are high, so that you don't run into that problem if we get into the point where interest rates could fall back. So a bit of a presentation. We're going to run through the different rates available on a number of different things, whether it's cash, bonds, shares, inflation-linked bonds, what you can expect from it, and then running through each of those, what the dangers are in terms of investing in them, and really what you should be looking for in terms of setting yourself up for a so that you don't run into any problems if we go through those lower interest rates again. So feel free to drop in any questions. I know this is a relatively it's a topic that may not appeal to everyone, but the people it does appeal to, I think, feel quite strongly and often have a lot of questions around how you can protect that money if you're trying to live off your income. So I'm going to start with just some long-term returns on assets, and this is sort of from a study that a book Trying for the Optimists, and it looks at different returns on different asset classes over very long periods of time. I'll often sort of talk about this, so sort of 100 odd years, and really what you get out of it, and adjusted for inflation in all these different countries, and really the key message is that your stocks are doing sort of 4 to 6% returns over that time frame above inflation, and then your bills, which is sort of not a bad indicator for what you might get in the bank, is looking at above inflation, but sort of 1% above inflation, and then the bonds are probably get you close to another 1% on top of that if you're over the longer term. But you will go through significant periods where either one of those that cash can outperform some of these other assets, and so it's not a matter of just sort of picking automatically, but there's that idea if you're going to stay in cash for long periods of time, you're going to get returns that are below bonds and below equities as well. Well, that's certainly been the historical experience for people. The other thing you need to, for income investors, really to think about is this idea about capital versus income. And so it may be that at certain times you do need to dip into capital to pay off income, and I know that often hurts for people. And I guess I'm presenting this as an idea about how to look at investments overall. There is a certain element where you should be a little bit agnostic to the returns, and actually often from a tax perspective, you are often better off getting returns as capital rather than as income, and getting discounts on it. But I do know psychologically for people, it is a big thing for people to feel as if I've got my capital, that's sitting there, that's growing, and I'm just living off whatever that capital's throwing out. And so if that's the case, I get that as a psychological need for a lot of people. And so from that perspective, you really should be thinking about which are the assets that are going to give me a steady income. Because we've been through some periods over the last 10 years where we've seen interest rates on bank accounts drop to pretty much zero, and so so that's an important factor. The tax, and then the other thing as well, which I'll get into for some of these assets. The actual structure of how you're buying these assets can actually often make a big difference in terms of how you're getting the income as well. So I'm going to use some bond funds as an example, but there's there's some ways where if you're buying the underlying bonds, you were getting this reasonable yield, but actually if you bought some of these bond funds, you actually didn't get the yield you thought you might have been getting from it for other reasons, which I'll dig into as we go through. So yeah, so structure is important, thinking about tax, and then that whole capital versus income. So I'll pop up a chart that just to sort of show the bank deposit rates you could have got over the last sort of 20 odd years or 30 years. They sort of have varied quite dramatically. So back in the 80s, you could sort of pick up 10, 12% in all these different bank accounts, which was great. But pretty much since the 90s, we've been talking about between 2 and 6% on different types of bank accounts. I've isolated this. There's a few different elements, but it's worth noting there's some pretty big differences. So the cash management account used to be the I guess the account that most people would sort of use as an investment account, and it's just worth noting that really over the last few years, it's got dramatically worse in terms of the interest rates that you can get on cash management accounts, but also over the longer term, it tends to be right at the bottom of the returns. And so it does mean if you are going to have income at the bank, is you probably do need to do at least a little bit of work in terms of making sure you're getting the right returns. There's a lot of sort of online savings banks and bonus savers, which give some pretty good headline rates. But again, it's a real matter of making sure that you're going to fit the criteria that they're looking for, and you actually will genuinely be, if they require whatever it is, a deposit a month and no withdrawals, or whatever the case is, that you're actually meeting that, because if you don't, then often the rates, or the rates that they actually pay versus the rates that they advertise, tend to be a lot lower. People are pretty optimistic about, no, I'm not going to need any of my savings, I'll never dip into it. But if the case is that you do, then the rates you're receiving can drop quite low. And it's worth noting we've got some really big divergences at the moment between the rates in terms of those cash management accounts. A lot of them are still under 1% in terms of the yields, whereas there's other accounts around there where you're sort of getting 4.5% at the moment in terms of the types of returns you can get. And the other factor though is the term deposits, which I've slotted in there as some lines on a 1 year and a 3 year. Not a lot of difference generally between the two, but it is worth noting how low both the 1 year and the 3 year got in that 2020 period. And it's not the first time you've seen some meaningful drops. So in 2008 we sort of went from getting 5-6% on that to sort of getting more like 3% on some of those returns. And if that's what you're using to live off your income, then halving your income makes a big difference. And even worse when you end up in a situation like 2021, where you effectively went from you probably relatively low rates anyway of 2 or 3%, but down to effectively zero. And so so the idea is how do we sort of sort that problem out, and what can we do about it? So the first one is really thinking about what we can do in terms of the government bonds. Now they're your safe asset, and it's backed by the Australian government, and you're going to be able to lock in your returns for much longer periods of time if you're using those. So if you look at the latest, so from earlier this morning, some of the returns you can get, if you're going to put, say, a 10-year government bond down, yesterday you were sort of getting pretty close to 4.3. Today's closer to 4.2. And that's locked in for the next 10 years. So, in comparison, you can lock in a 3 year with the bank at the moment for the average the RBA is talking about is 4% for the average 3 year loan. So, if you're looking at government bonds as a potential or as an offset, you can lock in your rates for much, much longer. The other thing you can do with a government bond is it does give you the option to sell at certain times. So I think partly you need to think about bonds in as well, the way I like to think about them from an asset allocation perspective is it's actually giving me an option. So if I'm looking at it, I'm saying I want a mainstay for my portfolio. I want to make sure that a certain part of my portfolio is going to earn 4.2% for the next 10 years. I can go, great, that's what I want. I'm going to buy myself a government bond. That's going to mean that I'm going to earn at least 4.2%. Now, if the economy in the meantime runs into trouble, it takes a tumble, say you run into sort of a pandemic, or you run into 2007, 2008 type financial crisis, the value of that bond is going to go up in value. So the yields are going to go down, the value is going to go up. I've locked in that 4%. So the day I've bought it, that's it. I know the return I'm getting over the next few years. And so, but what I can do is if the value of that bond goes up from $100 to $110, I can now sell that and go and buy shares at a cheaper price. So that sort of gives me that option. The flip side is, well, what happens if interest rates go up much higher and the value of that bond goes down? Well, depends on whether I'm selling it or not. If I don't have an impetus to sell and I'm looking to get that 4% return over that 10 years and just carry that, then I haven't actually lost any money as long as if I'm not trading it. And so it's a question about which of the bonds I tend to think about as I'm putting bond portfolios together as there's a section of it that is sort of a bit like a ladder, and that's just the part I'm holding. It's sitting in the portfolio. They're going to keep rolling off. One bond will roll off every year, and you'll take it and buy a 15-year bond on the end or whatever it is. And that's the type of we have some of those portfolios, very low fee, not a lot of thought behind it. It's just in there to keep your low fees and keep a return and income coming through. And then the option, then there's a sort of more of a trading part, which is like, okay, I'll buy some 10-year bonds and I might buy some load up a little bit more at the long end if I think interest rates are falling or markets can be a bit tougher or equities are overvalued, with the view that then I'll actually be able to use that part to sell and go and put that into stocks. So that's the bond part, and I think for investors that would be the key one I'd be talking about, is saying if you were if you would look at a period, if you either did look at a period, say from 2017 to 2021, and see that your income fell from what you had in deposits fell to nothing, or you're looking forward and thinking you're going to live off your cash and your savings, is that keep these interest rates in mind. And if if that's what you're trying to do, you just want to lock in a return, you can lock in 4 to 4.5%. If you want to go out 30 years, you can lock in 4.5% for the next 30 years in a government bond, and relax a little bit more if that was your primary goal, is that safety of income and making sure that that's going to keep coming in. I spoke a little bit more about structures though, and structures is important in bonds. So if you are buying these bonds directly, or you're buying them through a fund like ours that gives you the actual underlying bonds sit in your name, and you sort of get all the distributions, and you don't have to worry about what other people are doing in terms of tax, then these are the types of returns you can get, depending upon how you've structured it. But that's you can get what's called a running yield, which is how much you're going to get every year, which is close to those rates. The issue comes in some of the managed bond funds that you get, is that they'll give you these types of returns, so you're not going to miss out on the returns overall, but they might not give it back to you as actually distributions. So, and what I mean by that is, if you think of a bond fund is basically you and a whole bunch of other investors all sort of bundled in together in this fund, and there's people buying in and selling out all the time. And so if there's this inflow of assets where the bond fund goes from managing whatever $5 billion worth of assets, and then a whole bunch more people join, and now it's got $6 billion worth of assets, is the bond funds had to go out and buy more bonds. And then when people leave, they've got to go turn around and sell bonds. And that can raise capital gains and capital losses. And it actually causes can cause some issues in terms of from a tax perspective, where the bond fund actually decides, we made 4% over the last year, but we're not going to pay it out to investors, because if we pay it out to investors, it's actually going to realise some tax issues for us. And so we're actually better off for everyone's sake in terms of holding that money within the fund and not paying a distribution. Now, from the bond fund manager's perspective, that's probably the best thing. They're trying to manage the tax situation for all these investors, and all these people are buying in and selling out. For the investor who bought a bond fund because they wanted income, though, that's exactly what they didn't want. And that's what we saw from a whole bunch of bond funds, including bond ETFs, over the last over those couple of years pre and running into the pandemic, is that you might have owned a bond ETF thinking you were going to get these steady yields all the time, and all of a sudden the yields disappeared. And then you would have had to go on and sell the bond. Now, it may not be the worst thing, but I guess what I'm saying, if you're buying these things because you want that psychological, I've got my capital there and I'm just living off the income, then that can be disturbing for people who've invested in those types of funds. So that's the government bonds and the government bond funds. The one that's well worth looking at for people and keeping an eye on is the inflation-linked bonds. Now, inflation's obviously falling a lot at the moment, so they're not as it's not as big of a priority, and actually there's a lot of funds flowing out of some of the inflation-linked bond funds, but it is at least worth knowing how they work, because if your view is you want to keep your capital, you've got that idea that, I want to have my capital and then I want to live off the income that's coming through, inflation-linked bonds are exactly what you want. So you buy, I've just got an indicator, a chart up sort of showing what's sitting on the ASX side to describe it. So basically you buy your bond, your inflation-linked bond, government bond, and say it's, you spend $100 to buy this bond, and it might be paying you a 1% dividend yield in the first year. Let's just say it's paying annually. Most of them pay quarterly or semi-annually, but let's just pretend annually just to make it all a bit easier. So it's paying me 1%. If inflation over that year is, say, 3%, what will happen is the value of so I spent $100, I got $1 as a interest payment on it. Next year, because we've had inflation, now I'm going to get $1.03. And then if there's 3% more inflation the next year, I'm getting $1.06 plus a little bit. And the value of my interest will keep going up every year. And then at the end of the time period, I'll actually also get back all that interest returned to me as a higher. I'll get back more at the end. So I bought this thing for $100. Let's say it only ran for 1 year and we had 3% interest rate. Sorry, let me run it for 2 years. Probably makes a little bit more sense. So I buy it in the first year. I buy it for $100. I get paid $1 in the first year. The second year I get paid $1.03. I spent $100 because I've spent $100 and there was 3% interest rate, 3% inflation in the first year and 3% inflation in the second year. Now I'm actually going to get back, when this thing matures, $106 because it keeps that value of inflation in there. And so, so the benefit is, I get to put a lump of capital in, I get a return and an interest rate. That interest rate keeps increasing over time with inflation, so I get to keep track of inflation. And at the end of the time period, my capital gets back whatever inflation has been over that time period as well. So really good at locking in returns, especially if you're concerned about inflation or you've got living expenses and things like that. That's the upside. The downside is the interest rates are quite low because they're going to increase over time. So what you'd call the running yield that you're going to get is probably the best you could do, and you might your capital might be a bit constrained, would be sort of maybe 1.75% at the moment, but you're probably more likely to be somewhere between 1 and 1.5% that you're going to be getting on these things. But you could lock that in till 2050. There's for the next 25 years, you could buy a bond today, cost you about $98, going to pay you $1 every year. And that's going to increase at the rate of inflation for the next 25 years. So so a great way to sort of protect yourself from inflation. The only thing is, that the interest rates are very low, and so you need to have a lot. And so it's sort of one more tool that's worth sitting in your in your toolkit. The question will really comes down to inflation, and if you're particularly worried about inflation being higher than everyone expects, then these are these are good for you, because the market's sort of pricing in 2.5% inflation for on these types of things. So if you're expecting inflation is going to be much higher, then the inflation-linked bonds are a great way to protect yourself from inflation and to hedge that. The question in terms of what happens to inflation-linked bonds, thanks, Craig. If there's deflation. If there is deflation, they will go down. So your coupon payment will go down, and the value of your principal will go down. The other thing to note as well is they might not be. There's lots of different measures of inflation, and so depending upon what you need to make sure that your view of what inflation is matches up with how they're going to define it in the buying of these things. So if you're worried about deflation, absolutely wouldn't be in any of these inflation-linked bonds. You're much better off looking at ordinary bonds, because they will, that's prime time for investing in ordinary bonds. And so for me, I'm certainly not out buying lots of. We've got a small holding within inflation-linked bonds, but we're not buying any more at the moment. We're sort of we do have those fears that or we're looking for that bond part to really hold as interest rates fall, and I guess the pendulum swings further and out that way. And so my take is that now's not quite the right time, but there will be times when inflation bonds get to the right prices, and it's just grab them, throw them in your portfolio, and forget about it. Then the next, actually, I might just go quickly to a quick sales message, and then I'll come back and talk more about equities and what we're seeing there.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios.
Right. So, so there's, when it comes down to, let's talk equities, because there's a whole bunch of things going on in terms of equities. One is this idea that looking at Australian stocks versus international stocks and trying to work out which do we buy. So you certainly get tax advantages by buying Australian stocks. The Australian stocks pay out franking credits, and which effectively gives you it's an extra onto your dividend that effectively tax has already been paid for you. So if you're say earning $70 on a fully franked dividend, that's treated as if you actually earned $100, but you've already paid $30 of tax. And so if you're on the top tax rate, I've earned $70, but I only need to pay, and theoretically I've got to pay 50% tax if I'm on the top tax rate, or pretty close to it. In this case, I wouldn't have to pay $35. I'd only have to pay $20, which is the difference between the two. So it is a big benefit. People on pensions love it because they can get some money back. I guess the key thing I'd like to note with international shares is international shares often do pay a version of this. It's like franking credits that they pay. It is because it is tax that you've paid in a foreign country. The difference is you don't, if you haven't earned any money, you don't get a refund on it. And so I'd think about in terms of franking, foreign shares sort of give you maybe 20% of the value of franking credits you might get. So it's not completely all towards Aussie shares, but you do get some back in terms of the tax you've paid on shares internationally. The Australian government lets you offset that versus your income. But the thing with franking is, once we brought franking in, it really did change the how Australian shares were priced. So I've got a chart just sort of showing up that what the payout ratios were in terms of Australia versus the US, and sort of pre-franking you'd sort of get 60 odd percent dividend payout ratio. So a company earns $100, they'd pay out about $60 as a dividend. That then, once franking came in, that then diverged quite dramatically. The US, is has now settled to lower than 40%, and the Aussie market is up somewhere between that 60 and 80% level. So Australian shares are paying a lot more out in terms of dividends. So that's positive from that perspective. So they pay a lot more out, and you get a lot more back in terms of. You also get the added benefit of franking credits. The difference is they don't reinvest as much money. So Australian companies tend to look at their franking credits as, and how they're going to pay out as going, okay, I have built up a certain amount of franking credits because of the tax I've paid. These franking credits are of no use to me as a company, so I should get that out to shareholders as much as possible. And the question is, does that mean that Australian companies invest less in their growth? And so, yes, they pay out a higher return, but then they grow their earnings less than what you might find overseas. And certainly in terms of dividends and EPS as well, that has been the case over the last, say, 20 odd years. If you just bought an index fund in Australia in sort of round about just after the tech wreck, early 2000s, if you're earning $1 in dividends, you're probably earning around about $3 now. So you've increased your dividend significantly over that sort of 20-year period. But if you were say buying a US one at the same rate, that'd be worth almost $4.50 now. So your dollar 20 odd years ago, is now worth considerably more than what you would be getting back from your Aussie shares. So it is a little bit of an offset, and you do certainly see that within what's called a buyback. So what happens with companies is company earns, let's take that example, company earns $100. In Australia, they're going to pay out, say, $70 of that back to shareholders and maybe reinvest the other $20. In the US, they're paying back more like $30 or $40 as a dividend. But then what they tend to do is then pay out a whole bunch, as they'll actually go back and buy back their own shares, which actually generates greater growth for existing shareholders. And so if you look at the what types of returns or how dividends go, you sort of go, that it's very steady. I've got the S&P up here on as a chart. And for people listening in on the podcast, I'm just showing how much they pay in dividends, and it's a pretty steady line, sort of rising from, it's back in the sort of 2000s, sort of around about the 150, and now sort of the 550 at the moment, and sort of just gradually rising over that time. About a 30%, 25% downturn you sort of got, but in the 2008, 2009, but recovered that within sort of 5 years. Whereas if I look at that same chart, but for what's been in terms of buybacks, it's up and down all over the place. So there's some years it's massive, other years it's almost nothing, and it just bounces around. Quite volatile in terms of how they're looking at it, and I guess that's how the US companies and international companies tend to look at it. Is they'll go, the Australian companies go, I need to get my franking credits out, and then I'll decide what I want to do. Whereas the US companies tend to go, okay, well, we'll pay out our dividend, and then after we've paid out that dividend, then we'll decide, well, what investment opportunities we've got. We've paid out our $30 dividend. We've got $70 to work out other good investment opportunities, and if not, we'll go back and buy back shares and use that from that. So if you adjust for the buybacks, a lot of that difference goes away in terms of the difference between Australia and the US. And there's times actually, and even when you look from world perspective, there's times where you look at the how much the world paid out when you counted both buybacks and dividends, and sometimes it's above what the Australian rates actually are. So that's one part. That chart though as well is quite illustrative. That dividends chart on the US S&P, just to give you an idea as well that the dividends are pretty steady. You're getting if you've got a diversified portfolio. Now, if you're going to buy stock portfolios and only buy one stock or two stocks, or even if you're only buying one or two sectors, so you load up say on the Aussie banks because they pay high dividend yields, you can run into problems where they start cutting their yields, and we saw that during the pandemic and when things go wrong, the banks may well cut their dividends. And more importantly, in terms of dividends, is looking at resource companies, because they can and will cut their dividends significantly. But if you've got this broad portfolio, well diversified, and I'm using the S&P 500, but it's pretty similar on a world basis as well, there's actually not a lot of difference in the dividends from year to year, and they do grow. 2009, which was a pretty severe event, you sort of had your dividends fall sort of 25%. So if you were getting, you had a $100,000 portfolio and you were getting $2,000 as dividends, now that's fallen back to $1,500 for a year, and then started off again, and you're back to, within 2 or 3 years, you're back over that money. But from a year-to-year basis, that sort of $2,000 that you're getting in was growing over that time and growing quite quickly and pretty steady in terms of an income. If you invested in individual stocks, that may not be the case. You could see dividends cut. It could go to zero. It's a question of diversification. But broadly diversified portfolios, equity portfolios, are pretty steady in terms of the income that you can get. And even if you compare that to, say, housing, a lot of people, I do speak to a lot of people who talk about, it's great to have my rent coming in every month on the investment properties, and you're like, yes, but you can go through periods where people move out and all of a sudden you can't lease it, and you might be, or there's big payments in terms of what you need to pay for repairs and all these types of things like that. You might find that they could be negative some years, or it could be zero once you sort of net out lost payments you've had to make and lost tenancy income and things like that. Whereas that doesn't tend to be the case for sort of broadly diversified equities portfolios. It's probably not the case as well on a broadly diversified property portfolio. But for a lot, if you can have 30 or 40 houses spread across multiple countries or multiple regions and all that type of stuff like that, then you're probably going to have a much steadier income. But that's obviously a lot harder for you need a lot more money to invest versus it's a lot easier to get that diversification within stocks. Right, so those versus buybacks. I spoke a little bit about the amounts. The other thing I've got a few more things I want to talk about in terms of stocks, but we might just go to one more quick sales message, and then I'll come back and sort of talk a little bit more about how stocks perform, especially the Australia versus international and how that sort of sits.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
So once again, when you're buying stocks, the structure matters. So you can run into those same problems I spoke about with the bond fund, and we saw that in the financial crisis where there were people who had invested in property funds in particular were apt to this, and a lot of people who had invested in property funds were investing in property funds because they wanted that income and they wanted that steady returns. And particularly some of these unlisted ones where they ran into problems, debt gets repriced, things they stop paying distributions, and often these funds also locked up, and so you couldn't even sell your capital. And so they're the ones well worth having an eye to history. There was a lot of property funds during that financial crisis that went into that type of event. And so if you had something where you're like, yes, I've got this property fund, it's paying me this great 7, 8, 9% return in terms of yield, and that's what I'm using to live off, all of a sudden the yield goes away, or it falls to very low levels because whatever events just happened. And not only that, the fund's locked up, so I can't even sell. I had $100,000 in that, and I was earning, getting a $7,000 or $8,000 distribution every year to help my living expenses. All of a sudden, that $7,000 or $8,000 gone, and I can't even sell part of my capital because they've locked up the fund for for years until I can get that money back. And so those unlisted property trusts, unlisted funds, or even some of the listed ones that own a lot of unlisted assets, important to think of those very much as I guess maybe an enhancement to your yield, something where you might be able to get an extra, you might be able to get a higher yield from it, but you don't want to be sitting there and saying that's the money I'm going to rely on in terms of what you're owning. If you're owning the underlying assets, they're listed, they're large companies, liquid markets. It's a lot easier to look through these things and be able to come up with other solutions. Once you start straying into unlisted funds and funds that own a lot of unlisted assets, you can run into those problems when you least want that issue. So that's one part. The other thing then is there's Australia. I spoke about the Australian dividend yield being higher than international. So on Australia, you can get about a 4% return at the moment in terms of dividend yield, plus some franking credits, plus more franking credits. Internationally is a little bit over 2%. And so we spoke about how internationally that yield is growing faster. So you get to start with a lower yield, but it's growing faster, and there's a bit more scope in terms of the what they're doing in terms of buybacks and stuff like that. The other issue though is asset allocation, and what I mean by that is the Australian market is very different to what you get overseas. Australia is very focused on the financial sector and materials sector. And in Australia, that means that if I've sort of got a chart up here just sort of showing, table just showing some of the yields you can get from different sectors around the world versus Australia. And the financial sector in Australia in particular is paying you sort of 4.7% return. And the if you add in energy and materials as well, they're all sort of paying, those high fours. Into 4%. That makes up sort of 60 to 70% of the Australian market. And so, or 60 to 65, sorry. It's nothing like that on the world. So actually I've hidden my figures on that. So so world returns are in terms of financials is more like, those two sectors together are more like 20% rather than 65%. And so half of the difference between the yield you can get in Australia and the yield you can get on global stocks is because of that asset allocation. And so what I mean by that is, if you just said, okay, I'm gonna have a portfolio, I'm gonna have a world portfolio, and I'm gonna fill it with financials and resource stocks, then you could get pretty close back to that same yield again. You could end up with and especially if I was a little bit more specific about resources and energy as opposed to sort of the broader materials sector, I could very much come back to a portfolio that's going to give me a pretty close to the Australian yield just by changing the sector allocation. And that comes back to a theme I've spoken about a lot on this podcast, which is the Aussie market is a very different market to the rest of the world. If I was a financial advisor in the US and a person turned up and I told that person that I'm going to put 2/3 of my assets into banks and resource stocks, and something went wrong, I'd lose my license. Like that, they would look upon that as crazy. What the hell are you doing, taking 2/3 of somebody's assets and piling them all into two individual sectors. Whereas in Australia, that's the market. That's what we face. And so, keep in mind when you're getting a higher yield in Australia. So part of it's that franking credits and the lower growth. The other part is you're choosing to make this huge exposure into banks and it's huge exposure into resources. Now, resource companies are not well known for being steady dividend payers. They do pay some high yields from time to time, particularly when commodity prices are high, but they are more than willing to go to zero and have done plenty of times over the course. So if you're looking for something that'll help, give you a little bit of extra oomph in your portfolio, sure, throw some resources in there if they're on high yields, but and you like the underlying outlook, but definitely don't buy resource stocks if you're trying to look for stability of earnings, because that's not going to, or stability of income, because they are not going to give you stability of income. And again, they're going to pay out these high yields when everything's great, but when things turn bad, when you most wanted them to, they're going to let you down at those points. That's when they're going to, pull out and stop paying those dividends. So that's so those ones. I did at least also want to touch on Commonwealth Bank. It is just worth noting, Commonwealth Bank is one of the largest stocks within the Australian market, and depending on what index you want to grab, you can get you can sort of get well over 10% of your portfolio ending up in this one stock. And it's expensive. It's a very expensive bank. It's probably the most, depending on how you want to measure things, but it'd be pretty close to the most expensive bank in the world. It's trading on multiples that are above Google's. So, it's a, yes, you can get a higher yield from it than you can in Google, but the question is whether you want, is that really the exposure you want within your portfolio for growth purposes? And so, and that sort of does bias some of these choices as well. So yeah, so I guess I'd be a little bit more circumspect about how you look at the Aussie market in particular and the higher yields you can get versus international, and just trying to weigh up the pros and the cons within that. Right, and so I'll go quick. I'll just last call out for any questions. We have a question of the week, which I'll throw up, and then I'll just talk a little bit about that. The net effect of what we're or I guess what's the overall effect for income investors? A bit of a summary, wrap up of where you should be looking. And the question, I guess, for you is, what are the good income sources that we've missed within these thoughts, and that you feel are going to, it's a chance for you to have a discussion in the comments and talk about the income sources which you do think will be able to hold up in terms of downturns and more concerning if we start seeing interest rates continue to fall. So with that, I don't think I've got any more questions. I just want to note where we're looking in terms of investment side. So really, the key thing I want to bring up for anyone who isn't an income investor is thinking around that. Term deposit rates are great. Interest rates you can get on the bank are great at the moment. If you're worried that if this is money you have to live off though, and you need that and you want that income coming in, you should be using the opportunity right now to be trying to lock yourself into some longer rates. Might not need to be for all your money, but at least some of it you should be locking away for longer periods of time. So if we do go into lower interest rates, lower inflation, economic slowdowns, that you're not going to be facing the same effect we did a few years ago, where your interest rates go from 4% to zero. Looking at shares opportunistically for growth, ideally, keep an eye on inflation-linked bonds at the right time. You can buy them and forget about them, and they provide this exactly what a lot of income investors want, but the yields are low, and so yeah, it's a matter of trying to get the right yield on those. But they're probably, I'd say, your best asset if you can buy them at the right price is those inflation-linked bonds, because they give you everything you're looking for. But absent that, and the pricing isn't isn't that right? I don't think at the moment on those. Is more about saying lock in some solid returns with your bonds, and then look to try and work out where you can with shares. Lock in some growing returns where we can actually see that dividend grow over time. So that's all we've got for this week. I just want to highlight, you can pick up, you can read all our stuff across a whole bunch of different places. We are on Google Podcasts, Apple Podcasts, Spotify, most major and minor platforms, social media. You can tap in and see our stuff, or go to nucleuswealth.com/content. We're live every Thursday from 12:30. And if you've got any thoughts on guests or topics you'd like to talk about, then send us an email, and we'd be happy to have a look at your thoughts and your questions. Thanks. We'll see everyone next week.